And let's speak a bit more about the US dollar, as it is surely the main currency which takes part in the most of the currency pairs we usually trade. So we have to have a good knowledge of the US dollar from different sides. And I would like to point your attention to the US GDP growth rate. The figures were released on Friday, and the figures were bright. US economic growth accelerated from 1.4% in the second quarter to 2.9% in the third quarter. The data for the third quarter, this 2.9%, almost 3% growth of the US economy, is an advanced data. So two more times this data will be revised, but still the figure looks very, very good. And we can see that it's been really a while, several years, until we had such strong figure of the on the quarterly basis. So this figure surely act in favor of stronger dollar and US Federal Reserve's rate hike in December. Also, if we speak about the US labor market, it is an important it plays an important role in the Fed's decision. And here we have another interesting chart from Bloomberg. We can see that the orange here indicates the actual payroll change. So how it indicates the amount of non-farm payrolls, NFP, by month. And the blue here is the trend rate. As we know, the economy needs to add about 50 or 110,000 jobs a month to keep the unemployment rate steady. And actually, US NFP growth has been exceeding this blue columns for most of the months of this year. Only in May we had a very low NFP, but all in all, during summer and during other months before May, the pace of jobs gain in the United States was rather high. And this is another argument that December is really a strong option for the Federal Reserve to raise interest rates. Why do we speak about December and not November? The answer is very simple, and we have already spoken a bit about it. It's the US presidential election. At some point, it seemed that Hillary Clinton was far ahead of Donald Trump. Hillary Clinton is the Democratic candidate, and Donald Trump is the nominee of the Republican Party. Still, now the situation looks much more uncertain. Let's have a look at the latest opinion polls. They have narrowed after news on Friday that FBI has reopened investigation into Hillary Clinton's use of private email server case. This news has shaken positions of Hillary Clinton a bit, and we see that according to the national polls, her lead over Donald Trump isn't really that big. On this chart, we can see that this lead has narrowed in the past week. Also, I'd like to point your attention to the fact that the US election system is kind of complicated. So the national polls don't reflect the full amount of this complication. There are some entities which take part in the election in the so-called battleground states. So the process of election isn't direct. There are some intermediaries there, and it will depend on how the votes will be distributed in these intermediate entities and in these battleground states. So if we look at this complex data, the lead which Hillary Clinton is currently having over Donald Trump is even more uncertain. What it all means? It means that the uncertainty factor is really high, and the Federal Reserve won't raise interest rates until we know who is the president of the United States for the next term. So after election passes, after November 8th passes, then the Federal Reserve will probably be able to tighten monetary policy in December. As we know, monetary policy tightening is a kind of restrictive measure which curbs activity at financial market a bit. So this is not the move the policymakers would like to make in the situation of uncertainty. We certainly wouldn't want to bring more stress to financial markets. As a result, I think that traders can be pretty certain that the FOMC meeting will be non-event, but we'll get probably some very minor changes in its statement. And once again, I repeat this idea that this non-event FOMC will make us more focused on the other US economic data releases. Surely NFP on Friday will make the markets rather volatile, as it usually does. Probably this won't have a very big long-term impact on the US dollar, as it is likely that even if the Fed does raise interest rates in December, further pace of monetary tightening in the US will be rather slow, and the overall potential of the US dollar to strengthen is limited. But in the short term, in the very, very short term, as we will be trading on Friday, surely we have to be prepared for swings in the currency market and use the risk management techniques accordingly.